look at the bodies of this candle here, all these three candles in here, this candle here, the body of this candle, the body of this candle, and the body of this candle, and the body of this candle. You see how that's all really close to that same overall price level? What is that suggesting? This is suggesting that this in here is what would be deemed an institutional price level, okay, for trade. Okay, not an institutional price level like the 80s, 20s, 50s, and evens like we talk about. But what I'm saying is this is a good level to anticipate actual trade entries at, because there's a lot of activity around that particular price level. And you can see that they were in fact interested there because it took off and then never came back for a long period of time, many years actually. Moving on into present time of this recording, you can see the price had just recently come down to these areas, okay, as well. But when we get around these levels, just on the higher time frame, they have to be refined on the lower time frame, and then we're going to do that in this example here. But the next idea I want to bring your attention to is when you're looking at higher time frame charts, you also want to look at the overall market structure, not just the order blocks or old highs and old lows. You want to be looking at the overall price structure. Okay, if you look at what we have here, we have the market moving up from a low to a high, and then we have another market swing from here to here, okay, which is comparable to this move here. We have this low to this high. Okay, so we have a dominant price swing here, a retracement, and then another rally up. But this price swing here is the second leg of what this leg is already done inside of this initial parent price swing. So if you look at what we have an equal distant measured move type thing, an ABCD extension is commonly referred to in price action or technical analysis, if you will. This low here is significant. Why is it significant? Because it's one of a multi-leg price structure. So now, knowing that, combine what we've just discussed, we have a market that moved from big ranges down into smaller ranges, and we moved into consolidation. What is going to happen, or what we would rather expect to see at that time? Okay, and again, I got to speak in a certain measure of hindsight here to be able to teach the concept, because what I'm going to show you in a moment, it's going to be a lot more significant to you. But for now, understanding that just because we're looking at old lows isn't enough. You want to look at the market structure as well, because what I'm saying to you here is there was a lot of buying here, there was a lot of buying here, but there was a lot of buying here as well. Okay, so there was a lot of order flow entries right in here in the long side. Why? How do we know that? Well, because it obviously took off. But why would we expect that? Well, if you go through the candle here, cut right on through that, you'll get to these highs over here. Continue going over to the left again. Cut through these candles. What do you see? A lot of buying here as well. See that move here? See, there's this idea that supply and demand is what I teach, and it's not what I teach. Okay, I teach institutional order flow. I teach how the banks view charts, how they look at areas of previous fair value and price disparity, and where they look to do their buying and selling, okay, is important, not how supply and demand traders look at price. Okay, I don't care about rules that were created by a ticket runner not to cut through candles. Okay, I worked and rubbed elbows with bank traders, and I'm telling you, we don't care about cutting through candles, because you're not going to see institutional buying if you just stop at a present range and never look beyond it. Look at what I'm suggesting to you here. You're going to cut through this area here is of importance. Why is it important? Because if you cut through this candle here, go all the way over here, this level here is now significant again. And cut through this candle here, this area is significant again as well. Now, if we take the body of the candle right here, just the body. We're not looking at the long wick. Okay, I just want to focus on the body of the candle here. You nail it here, and you're in it here as well. But more importantly, prior to this big move, look what the body of the candle is on the down candle prior to the big move is. It's inside that area. Supply and demand does not give you that precision. ICT does. Okay. Now, I'm not patting myself on the back. I'm just telling you, you are light years beyond what everyone else is teaching and learning from everyone else, okay, out there on the internet and all these other supposed seminars and teaching, circuits. They're not aware of this stuff, okay? Um, you are going to be limiting yourself if you do not cut through candles, okay? You got to go through it. You got to go through and look at overall price structure and blend it with institutional order flow. Who were the participants that caused this market to move up? Is it supply and demand traders? No. Is it support resistance traders? No. Is it retail traders? No. Absolutely not. It's not baby pips, okay? It's not FX Street people. It's not Forex Factory Forum guys. It's none of those people, okay? It's banks, institutions, large firms. They are the ones that create these large extrapolated price moves, okay? So when you're looking at price, you have to identify when markets are moving significant, okay? Those are footprints that large buyers or sellers are interested in those levels, because in those levels, okay, we're in areas that they're going to be doing future trading again, okay, and they're going to be influential to you as a price action trader, both on buying and selling. And how we measure that and lay that out with market structure, and we're going to talk about that in this video. It's going to be paramount to you being successful using these concepts. Now, do you need these concepts to be profitable? Absolutely not. But you will not find anything else this precise that gives you the foresight to know when to anticipate it, how to anticipate it, and have the, well, everyone asks me all the time, the bias, if you will. Okay, this is how I arrive at it. Okay, so now, when we see these areas, okay, all they do is draw the attention to where there's large institutional order flow. But they have to, much like everything else I teach, they have to be further refined. So now we have an area in here. We have this down candle right here. Okay, that down candle prior to the move up here, it retraces back into it right there. Okay, and then boom, it takes off. If we take this idea, in much in the same vein that we cut through going to the left to find historical support and resistance theory in the order blocks and market structure, okay, this concept can be projected through candles like we see here. And if you look at what we have, we're going to just take the range and just extend it out in time, and you're going to see all of a sudden this reaction that no one else saw. But we talked about this level here. Okay, if you look at my old videos, we talked about the likelihood of the 172, the 171.80 level. Okay, that would be a significant area to expect some selling pressure. Okay, and in fact, when price was rallying up here, we were talking about the false breakout idea above this high here and this high here, moving up into this old low. Now, traditional support resistance traders would expect you to believe that it's going to work like this. Okay, and you're going to see a glaring disparity between what we teach and what actually happens. A low here on this candle comes in at, let's get it on here, the low comes in at 170.46. The actual high that it moved to was 171.92. That's a pretty significant difference. Now, not so much if you're a higher time frame trader and you use multiple hundred level stops. In other words, if your stop's several hundred pips, which I don't trade that way, but I mean, there's traders that can trade that way and feel comfortable doing it. This probably wouldn't be a big deal to you, but because I'm an intraday timing type trader, I like to use a 15-minute and 5-minute entry on something I've arrived at on a higher time frame. That's a big disparity between 170.44 and the 171. What is it? What do we have here? Get back to it again. 171.92. I mean, that's a significant difference in terms of overall risk exposure, and in deference to the pips that's necessary for your stop. But what I'm drawing your idea of looking at price in a way that it will give you the understanding that's necessary to flesh out areas of anticipation when we anticipate price. Well, when we're looking at higher time frame price charts, and say prior to this move up into this high here, as price was rallying up, we were bullish all through this. If you go back and look at all of my YouTube videos, we were calling higher prices in the cable, higher prices in the euro, lower prices in the dollar. And if you go on my website, you'll see links for market reviews that were discussing all this as well. The idea was you look at old highs, okay, for price to reach to them. And until we reach them, you maintain a bullish stance. Now think about what I just told you. Okay, write this down in your notebook in big bold letters and then highlight it and circle it and underline it. Okay, when you're looking for an idea to trade on, when you're looking at higher time frame charts, where we are at now, presently, you ask yourself, where is price reaching for? What price level is it reaching for? Where's the next level of institutional interest? Okay, prior to this move higher here, there would have been an interest above these highs here in the form of buy stops. There's a lot of traders that believe that if they break this high here, it's probably going to continue all the way up, maybe even trade back here. Now, obviously, we saw that wasn't the case, but there's a lot of people that believe that in the market. And there would be traditional support resistance traders would say this would be a good area to anticipate price reaching to, and that would in that camp they would be correct. Okay, but when you understand institutional order flow, let me ask you this: does this high and this high have any institutional significance other than the fact that there would be buy stops above it and here as well? No, because all we have here is a big range. We have this really big range in here. Okay, so you got to cut through that range and find out what the previous institutional structure right here. Boom. You got to go through candles to find out where price is most likely heading. Now let me ask you a question. The buyers that would have had positions here and were long here, okay, when the market traded through that, did it ever get to that same level again once it broke through? This is the closest it got. And then we had to go through 4 years to get back to that same price level right there. Now, let me ask you a question. What retail entity would hold a position that long losing? I would argue none. Most of you can't even stand an hour, under the water in a position before you start going crazy. But I'm going to remind you about something that, again, the retail universe cannot grasp this concept. But banks can hold net loss positions a lot longer than you would have yourself believe. Because they are the market, okay, they are willing to allow themselves to sit with a deficit on their books because they have other transactional costs that they charge their customers that help offset the what would be deemed as a net loss or losing position on an open position, if you will. They're able to kind of like diversify their income to offset, not entirely, but offset some of the adverse problems of holding that loss on their books. They will, when price gets back to these levels here, they will then unwind what would be at the time here. Okay, once it's taken out that low, now they're in a net loss, a rather significant net loss position. Okay, you're looking at a very, very steep decline. Okay, and this is exactly when we had the banking fallout. We had all that issue with the banks potentially failing. and we had to do the bailout. Everyone knows about that. But now they had an opportunity to now mitigate that. So everything they were sitting in with any positions that were net long still from this point on and holding on to it, okay, they had to sit through all this, and then technically they came out of it right here, and that's what you're seeing. Okay. Now on the lower end, okay, because we just described how we cut through all candles to get to an area of understanding of where institutional interest is on higher time frames and how we look for price action to move to different levels. When price started to fall from here, the question is going to be is where would there be an interest of seeing price get to? We have a down candle here, so as price was dropping, this was a significant level to be monitoring. Okay, and if you look at the bodies of the candle, there was a significant interest. If you go down to a lower time frame, you can clearly see, and I'll let you do this on your own study. You could have been taking trades on both sides of the market, I'm certain, around that same level. Now, did it continue on lower? Yes, it did. Okay, what will be the next level of interest? The down candle prior to the move up, okay, it's going to reach into that. Okay, we got down through it around the holidays. Okay, and then below it would be these equal lows because we understand that there would be sell stops below these lows, and there would be a liquidity void down there, and price would reach for it. Okay, price coming down into a level that if you cut through candles now, we're going to cut through this bunch of candles, we're going to cut through this bunch of candles to arrive at the same order block we had back here. It's the beginning of this move here. Now we're back in an area of price sensitivity again. Okay, so we can anticipate an area of buying pressure to come into the marketplace again. So we're looking at higher time frame charts with an idea that where are institutional traders most likely interested in trading based on what's already happened in the past and previous footprints that they've left. Because if they were interested in buying it back here, okay, that's a significant price level if we get back to it again, especially if you understand what it means in the whole grand scheme of things. If this position was a buy and it went through it here, they're going to want to get out of that there when it gets back to it to mitigate that. So this is a bullish order block that becomes a buying opportunity here for a buy setup, but it becomes a mitigation block later on in time. And yes, you're cutting through candles to arrive at that understanding. Okay, so again, it's not supply and demand, guys, it's institutional order flow. Now looking at what we have here, if we take ourselves down one period and we go to a weekly chart, and let me click the weekly chart tab, not the monthly again. Okay, we're going to zoom out again, and let's get this off because I don't need it. We have this trading range defined here, okay, but look, we have this reaction as well. See this reaction? We're going to zoom in on this little area here, right in here. Okay, we have big ranges, and then what happens? We go into small ranges. What's the small range going to create? Big ranges. Okay, and then we have down candle, range expansion again, retracement, small ranges, big ranges, retracement, big ranges, small ranges. Then what's going to happen? Big ranges. Okay, what you're looking for again is areas of